Want to hit on the stock market sell-off. Stock market, volatility's back. Cisco plunged to 11 to 12% on disappointing guidance. And is this investment turning around to profits fast enough to justify some of these high stock prices? And something takes place within the economy or the market that then bleeds into other industries. Welcome to the Wise Money Guys. This is Giuseppe Visconti. My co-host John Scambray is out for this week. We are One Source Wealth Management, and we are located in Granite Bay, California, have offices that we utilize throughout Northern California, anywhere from Bay Area on up to the greater Sacramento area and Reno. You can find out more information about us. You can go to our website, wisemoneyguys.com. Which has information about our firm, as well as bios on myself and John. Has a lot of tools, calculators, retirement calculators that could be useful. And then obviously all of our disclosures at the bottom. Both John and I have been doing this for a combined 50 plus years, and we seek to help retirees or near retirement individuals and families live out their financial dreams. We do that through the source of financial planning, and you will have an opportunity to come see how we do that, learn a little bit more about who we are, how we work with our clients, and how we help them get to their goals and get them from point A to point B, especially during their retirement years, to create longevity for their hard-earned money that they saved up to be able to retire. That opportunity is going to be coming up here March 4th at the Wood Creek Golf Club from 5:30 to 7 o'clock in Roseville. And there, what we do is we discuss, as I said before, more about who we are, what we do, how we help our existing clients, how we could potentially help you, pull back the covers as far as, what goes into the details of, financial planning from the start to finish. What are some of the things that we look at as far as putting an appropriate portfolio together for you to create longevity that's needed to have your money last throughout retirement, and also plan for the what ifs because nobody's got a crystal ball and curveballs are thrown at us, throughout time. And how do we adjust for that, right? How do we make up and whether it's the market, it's the economy, different things that are happening in your life, events happen all the time. How do we adjust to be nimble and make those adjustments within your financial plan, as well as then make those adjustments within your portfolio so you can continue and create longevity for your financial goals without having any worry, right? So today we have quite a bit to talk about. Want to hit on the stock market sell-off. A lot of people seeing it, especially in the AI and the tech sector. Software stocks are getting hit. What's kind of the broader sentiment out there? And then what's the backdrop of the economy? And, is it really affecting kind of the big picture of things, or is there anything that we need to really worry about? Or are we still kind of plugging along here? And this is just a speed bump. Tax season is upon us. So I'll touch on a few things just because there's been, we had the 2017 tax jobs cut or tax cut extended with a couple new, improved and increases in some deductions that we'll be able to appreciate doing our taxes this year that have taken place in 2025. And then also wanted to touch base on benchmark revisions, final benchmark revisions on BLS, Bureau of Labor Statistics. That's been kind of a hot topic. We've had major revisions last year that we've witnessed, and we continue to have them. So when data comes out to figure out how well is the economy doing, do we take it with a grain of salt? Are there other things that we need to look at? So I'll discuss a little bit about that and how that's impacted the market and kind of what you need to, or what we look at, especially being on our side of the table to determine where is the economy going and do we need to make any shifts within clients' portfolios or take into consideration things that we need to adjust within their plan. So to kick off, stock market volatility's back. John and I have talked about it in past episodes. We were anticipating this to take place beginning of the year, mainly because there's a lot that's going on. We had the Federal Reserve meeting, which they've had some rate cuts last year. Now they're on pause. When's the next rate cut going to happen? We also have tariffs that have come back in play. A lot of tariff talk that's caused some volatility. And then, the AI, which is still dominating the market. Last few years, the Magnificent Seven has really dominated the market as far as some of the big tech names, Google, Microsoft, Tesla, NVIDIA, so on and so forth, which are the part of the Magnificent Seven. And we've talked about, that there's a shift that we're seeing, and we don't think that the Magnificent Seven is going to dominate the market like it did in the past few years. But that's what the market investors are looking at now is, all the investment that's going on and taking place in the AI names, and that's geared or focused around artificial intelligence. Is it going to be paying off? And is this investment turning around to profits fast enough to justify some of these high stock prices and some of these, technology names? And we're seeing some disruption from that. And, people are looking for other areas. Do you stay in technology? Do you stay in AI focused names, or do you go elsewhere? I think within the, S&P 500, if we're focusing on that, just because when you're watching the news or searching like, hey, how well did the market do today or this week or this month or so, so far this year, a lot of times referencing the market is S&P 500. Dow Jones is another one, but it's only made up of 30 companies. And that's hit over 50,000, which is, a high point. And then you have the NASDAQ, which is more technology focused. But I think the other 493 stocks of the S&P 500 are starting to see some, having some light shine on them. So they're picking up kind of the slack from where the technology is getting hit a little bit right now, and it's broadening the market, which is creating a healthier stock market, really, because you want a stock market that's broadening out within other names out there, other sectors, other than just focusing on one sector or area of the stock market. Some names that were hit: Cisco plunged 11 to 12% on disappointing guidance. We've seen some other tech companies get hit by either overinvestment and kind of worries around that. Broader software ETF. So if you're like in a ETF fund, exchange traded fund, or maybe mutual fund that's really tech focused and has a bigger weighting within these mega caps or Magnificent Seven, some of those funds have seen, a 4% drop just because of some of these names: Amazon, Microsoft, Cisco. NVIDIA has been a little bit resilient. They've gone down, but then they've popped back up recently. So that's one thing to pay attention to. And we've talked plenty of times, what is it that you should be doing if your portfolios are focused just around some of these technology names that have done so well in the past few years? It's time to diversify. It's taking some of the profits and then spreading some of those winnings, right? And spreading the love across other different sectors. Industrials, financials, even though financials have recently been hit, still look like some good fundamental growth areas. And there's a few others out there. What's going to be good for you? What is going to make sense for you in your portfolio? That's where it makes sense to talk to, people such as myself or John, right? And a firm to get the advice, because everybody is different, right? Everybody has a different timeline. Everybody has a different risk tolerance. Goals are different. A lot of times I'll be asked, sometimes from friends mostly, and this is just recently, like, hey, what is a good number that I should kind of keep in my head for retirement? And I ask them, what do you mean? They said, well, like, how much money, do I need like $2 million, $3 million? Like what's a good number, for people to retire? It's really subjective. It just really depends on, who you are. We have clients from all walks of life. So some say, hey, I have everything paid off. I'm a homebody. I don't need much. All I'm going to spend is $50,000, $60,000 a year in retirement, and that's sufficient for me. And as long as that continues to increase over time, to keep up with inflation, then that's sufficient. We have other clients that, they have a little bit higher standards and they do things more. They travel more, whatever the case may be. They splurge on their family, whatever case, and they want to spend $150,000, $200,000, more than $200,000 a year. So that's all really going to depend on what is that right number for you that you're going to be able to retire, and be comfortable once you turn your earned income into passive income. And I can dive a little more into that when we come back. I'll also touch on a little bit on the broader sentiment, the economic backdrop. And then in the future segments, we'll talk about, some tips on the tax season, some of the changes, which will help all of us, hopefully, with upcoming taxes when we do them here in the next couple months. You're listening to Giuseppe Visconti, Wise Money Guys. We'll be right back. Welcome back to Wise Money Guys. My name is Giuseppe Visconti. Again, John Scambray is out for the show. He will be back with us next week. We are certified portfolio managers. John and I have a combined experience of over 50 years. Worked in different areas within this industry. Along with being a certified portfolio manager, and I'll dive into that a little bit. It's just an additional designation, which, makes us students of this market. And, there are licenses and different requirements in order to get into this industry, but we like to continue to be abreast of what's out there because, investments, they just continue and this world just continues to evolve and change. And in 2018, I found a program that was affiliated at the time with Columbia University and took it to John and said, hey, I think this is pretty cool setup. It's newer and it focuses on, portfolio management, risks, asset allocation. And then we get to, go through, once you complete, it's about 6 months or so worth of testing and quizzes and reading material and what have you. Once you pass all that with a certain level, then you can go on to New York. And actually we sat in for a week at Columbia University and sat into, the lecture halls and the professors there at the applied mathematics department and blew us away. But what was, invigorating and inspiring about that is we really got to learn quite a bit. Some was refresher and then others was, wow, like we didn't really know, the depths of some of this, within portfolio manager or some new ways, right? Here's an old way that portfolio managers or measured risk or things that they looked at risk, but here's some of the new ways that portfolio managers are looking at risk and some different measurements. And here's why. And so that was a really good experience. From that, that inspired me to actually go back to school and obtain my graduate degree and get a master's in finance and economics. And we continue to just try and, pump as much information as we can, on our end to navigate the market as best as we can, find what's out there in the world of investments, to be able to custom tailor portfolios for our clients, to help them achieve their goals, really, without taking unnecessary risks. Because that's really the bottom line. Last year, not as much, but the year before in 2024 and 2023, we've heard it from our existing clients, is, how do I find like the next, NVIDIA stock or this stock, or how do I, double my money in the few years, or, that's exciting, but is it realistic? Can it happen? Yes. Is it realistic long-term? No, it's going to be putting a lot of risk, and unless you need to take that risk for your financial goals that are important to you, it's unnecessary and it's going to cause a lot of volatility. Last thing you want to have happen is you take some unnecessary risk to go after the gusto, and then there's a bad year, right? Because nobody has a crystal ball and things happen in the world or in a country. And then it can have an impact. There could be a systemic risk, meaning that something takes place within the economy or the market that then bleeds into other industries, right? I'm not talking about kind of the speed bump that we have right now. We have some volatility with maybe some AI overinvestment and maybe, the concern of, are the profits going to happen fast enough? Are we going to have the infrastructure fast enough to support this AI growth as far as the energy grid and data storage and what have you? This is a speed bump, but I'm talking more of a systemic risk, which we saw more in 2022 when interest rates were rapidly rising, when the Federal Reserve were rapidly rising interest rates to battle inflation. It hit everything, right? It hit the tech market. It hit, S&P 500 and a lot of different, companies. It hit the bonds. So, if you had stocks and bonds, it hit both. We saw systemic risk, in 2008, where everything got hit. So you don't want an event like that happen, and then you're on the side where you've taken too much risk for the sake of just trying to go after high returns, but they weren't needed. They weren't needed for your long-term goals. And so we find ways of how can we best put together a portfolio? What are the investments out there? Let's diversify and try and, look for not only just the conventional traditional stocks and bonds, but then looking at different alternatives out there. Different types of real estate investments, different types of alternative investments within the hedge fund strategy areas, long, short, private credit, throwing a lot of terms out there. Maybe you've heard some of them before, maybe you haven't, but the short of it is to put together a portfolio that's going to give you the optimal return that's needed without taking the necessary risk. And then when we have these bumps or volatile periods, like we're having a little bit right now, you're not worried. Your portfolio is not overly impacted, right? If we can capture less of the downside and capture more of the upside of the ups and downs of the market, that's the overall goal, right? Because that's then smooths out the line, and it creates a more comfortable ride through your long journey throughout retirement. And again, if you want to have the opportunity to learn more about us, see us, live in person, be able to interact with us. We take questions at the end, learn more about our firm, who we are, how we work with our clients, and how we help them get from point A to point B. Again, we are going to have that seminar coming up here shortly, March 4th in Roseville at the Wood Creek Golf Club from 5:30 to 7. You can also, like I mentioned in the previous segment, find out more about us on our website, wisemoneyguys.com. We will have a new website coming up. We're refreshing it. So that should be coming up here shortly, within hopefully the next few weeks or so. Going back to what I left off in the previous segment, AI is shifting and is putting some pressure on stocks, but we're seeing more of a rotation to value stocks and John's favorite energy sector, which has been, coming up, as well as industrials, healthcare. Financials have taken a recent hit because of some AI scare, really, with Anthropic and the wealth management of some of the tax planning and what AI can do that some firms do these days. But I think that's a speed bump right now. And I think some of those industries or sectors we're seeing that a rotation into those right now. Overall, for the economy, we look at the backdrop. Jobs report recently, it showed 130,000 non-farm payrolls, which beat the low expectations of 55,000. That dipped the employment to 4.3%. So we're very resilient right now. I mean, the unemployment is still relatively low. For a small portion there, it was starting to increase, and there was maybe a little concern of, okay, if it's going to continue on this trend of increasing, especially when unemployment gets to about 5%, north of 5%, it starts to become concerning of, hey, what's going on with the overall economy? And are we needing to pay attention to this? Well, Federal Reserve has been focused on that. That's why we saw a few rate cuts last year from them. But because we've had some strong GDP, gross domestic product numbers come in, job numbers have been pretty strong, unemployment dipped. This is why we've seen the Federal Reserve pause on the rate cuts, and they probably will continue to pause. Maybe we'll see, where it lies in the middle of this year. But overall, the strong economy, rates have been, coming up and down. Recently, they've come down a little bit. Oil's come down. This is going to help the consumer. When the 10-year Treasury, we've talked about this before, the U.S. Treasury bond, when that 10-year Treasury yield starts to come down, that's good news for borrowers, especially, people who are trying to get into their first home or maybe upgrade their home or move or whatever the case may be. That 10-year Treasury is really what needs to be looked at, because that's a barometer that is focused on when you're looking at, where is interest rates right now if I need to get a mortgage or a car loan or what have you. And so that's recently dipped down. And you typically see that when there's volatility in the market, because then investors will flee to safety, and safety is U.S. Treasury bonds. We've seen safety in gold. We've seen gold go up quite a bit, and that's come down. The store of value, what's been talked about, as an alternative to gold in the past, not so much now, has been Bitcoin, but Bitcoin has been very, very volatile. It's now in the 60,000 area. I think it was like 67, 68,000. Where does it stop? Does it go up from here? We've had clients, last year when it was, over 100,000, get excited. And this is what typically happens. And this is what I was talking about before, people trying to go after the gusto and getting excited, trying to go after returns like, hey, should I get into Bitcoin? Here at the level where it's at, $100,000+, probably not. You want to wait till it pulls back. Well, it's pulled back. Has it hit a stopping point? There's material out there that say that it can fall further into the 50s. There's some material I read out there that it could drop into the 30s. So, you want to see where it bases out from there. And then, does it make sense to add to your portfolio? It's definitely earned a place as another asset class within the investing world. But it's another thing to figure out if that is a place to be added within your portfolio and if it makes sense for your overall goals. Those are the things that we discussed within our seminar coming up here in March 4th, or you can always give us a call. No obligation consultation if that's something that you can't make, and you can reach us at 916-967-3500. All right. I have to take a break here. When we come back, talk about some of the updates within taxes and what's changed and what we're looking forward to while everybody's doing their taxes here in the next couple months. My name is Giuseppe Visconti, Wise Money Guys. I'll be right back. Welcome back. Giuseppe Visconti, Wise Money Guys. John Scambray is out for the show. He will be back with us next week. We are certified portfolio managers, represented by One Source Wealth Management, our firm out of Granite Bay, California. We serve Northern California all the way through Reno. And we have a network of offices that we use anywhere from Reno down to the Bay Area. We have an upcoming dinner workshop where dinner is included in Roseville. It'll be the first of this year. That's on March 4th from 5:30 to 7 p.m. at the Wood Creek Golf Club. Definitely call in at 916-967-3500. And you will speak with our office manager, Kathy, to RSVP. Seats fill up. So it's better to call in earlier rather than waiting to the last minute because we do have a certain capacity limit. So again, 916-967-3500. You can also give us a call just for a no obligation consultation if that date doesn't work for you or you're not in the area. And we'd love to talk with you to do a portfolio analysis or complimentary review. We lead through financial planning, and that really sets the foundation of what's needed to get you from point A to point B. Are you on track to hit your goals that are important to you and your family? And then, do the assets that you have invested or you saved up, do they align with your overall plan? And so that's what's entailed, is included within the consultation. Doesn't cost you anything. What it does do is it gives us an opportunity to meet each other, learn more about us, more importantly, learn more about you, a little bit of your past, your current situation, and then what your future endeavors are and what's important to you as far as your financial goals. Put it together on paper as far as a financial plan, and then it puts everybody on the same page as far as, hey, this is where I'm at. This is where I want to go. Here's what's important to me and my family. Here's some of the financial concerns that I have. Here's everything that I've saved up and or I have invested, and then can I achieve the things that we want to achieve based off of what I've done so far? And if not, what are some of the pitfalls? What are some of the red flags that we might see? Or what are some areas that you can improve upon, right, to create that longevity? Also, what might be some curveballs in the future that we want to plan for, and what could derail your your overall investments in your financial plan? A lot of what people have been feeling the pinch is inflation. These past 5 years, things have just become more and more expensive. Especially these past 5 years, anywhere from, goods that they buy to services that they pay for, right? It could be subscription services. It can be, even my wife, her gym membership has got increased like 3 or 4 different times. Home alarm service. I've had ADT for a while now, and that's almost doubled as far as the monthly service fee on that. Here in California, we're going to start to feel a pinch on gas. We've always have, just because we have so much embedded gas taxes within, each gallon of gas that we buy. But now that Valero is out and Chevron is looking at, taking away their refinery, that's less refining, and that's going to put more demand on the existing refineries that are set there. What is that going to do to gas? We will see. Talking to some people within the industry that I know through some friends, they're expecting that if it kind of stays the way it is and Chevron and Valero are offline, we can see up to $8 a gallon in gas in California. So hopefully not. Hopefully things change before then, but that's what we're dealing with on an everyday basis. And, this is a good time, if you haven't, or it's been a while since you've done a plan, to visit it, right? Or to get a second set of eyes. If you don't have confidence in the plan or whoever you're working with now, have a second opinion, a second set of eyes. Financial advisor, an attorney, a doctor, kind of all in the same realm. You go to a doctor, they say, hey, something's wrong with you. Some people will just take it at face value and say, okay, what do I need to do? And you go ahead and do it. These days, a lot of my friends and family, they'll, if it's something serious and concerning, they'll go to another doctor and get a second opinion, right? And then they weigh their options. So same thing with your finances, right? They're very important to you. You've worked very hard to build up what you've had to build up, and you're turning earned income into passive income. And now you got to turn all the money that you saved up and flip a switch on and start to have it produce a paycheck for you, right? Every month, so you can live the way you want to live and have it last for 20, 30 years. So it may take a second set of eyes or another review on a plan or different approach to really hone in for you to make sense of, hey, am I really on track? Am I comfortable with where I'm going with this? So again, March 4th in Roseville, Wood Creek Golf Club from 5:30 to 7. Hope to see you there. You can RSVP at 916-967-3500. So tax season is upon us. We've had some increases to deductions last year in 2025 that we'll be able to now realize. And some of those is a standard deduction has gone up. I'm just going to read through some of these here in my notes. 2025 or 2024, the standard deduction was 15,000, or is up right from 2024. And now it's $15,750 for single or $31,500 for married filing joint. So you can either itemize, deductions, or you take the standard deduction. And the standard deduction is pretty generous. A lot of people end up taking the standard deduction, unless you're a business owner. A lot of business owners will obviously do itemized. Another really big one is SALT, state and local taxes, which includes property taxes. And that's a big difference here for California homeowners because it increases from $10,000 to $40,000. So for a little while there, we're only able to deduct and take into consideration $10,000 in property taxes. And, there's plenty of people, especially in California homeowners, that have more than that in property taxes. Contribution deadlines, remember, for IRAs and HSAs, health savings accounts, those end same as tax filing deadline in April. So any contributions that you want to do to your IRAs, traditional IRAs, or your SEP IRAs, you want to make that before the deadline. And remember, sometimes we get this question from retired folks is, hey, I have an IRA. Can I contribute towards it? Can I contribute to a Roth, or can I contribute to a traditional or my SEP? Answer is no. You have to have earned income, right? And earned income doesn't include income from like Social Security or a pension or what have you. So you still have to be working, whether you're self-employed or you're working for a company, and then you have earned income, then you can go ahead and contribute to the IRA or HSA. Those contribution limits have gone up. So 2025, if you're making the contribution for 2025 year, that was $7,000 if you're under 50 years old. If you're 50 years or older, then you can do $1,000 catch-up contribution, which is $8,000. And then the SEP IRA was $70,000. And then for 2025, that's going to be increased to $72,000. That you'd be able to contribute as far as the max for 2026. IRA contribution, you always have that catch-up contribution of $1,000, but that's increased as well for 2026. So some things to look out there for taxes. If you have some, we're not CPAs. We know enough to be dangerous, and so we do help around some guidance, but we always defer you to your accountant or CPA that you work with, because they know your tax situation in detail a lot better than we do. But some of the things to take in consideration, we've mentioned towards the end of last year, and one thing to pay attention to when you're going through your 1099s and your tax summaries is, when you're focusing on your investment accounts, your taxable brokerage investment accounts, not your IRAs, not your retirement accounts, and you go through and you go to the section of capital gains, dividends and interest. The capital gains is where we can help as portfolio managers. And the way we can help is, and if you're looking at your 1099 summary and your brokerage and you're saying, wow, I had, quite a bit of capital gains last year, and now I have to report, I'm reporting that on my 1099. I'm going to have to pay, I'm going to write a check to IRS for cap gains taxes and state of California. That's where we can help through tax loss harvesting. And so, tax loss harvesting is just a method to try and capture some losses to offset those gains. And I'll go more into the details of that and how we help our clients with their taxable brokerage accounts when I come back. And again, feel free to give us a call, 916-967-3500 for a no obligation consultation, or to get a seat at our March 4th dinner workshop coming up in Roseville Wood Creek Golf Club. Again, 916-967-3500. And more on tax loss harvesting when I come back. back. I'm Giuseppe Visconti with the Wise Money Guys, brought to you by One Source Wealth Management. Again, you can find out more about us and our firm by visiting our website at wisemoneyguys.com. It's got information on our firm, bios on both me and John, as well as it has a lot of information just on general markets. It's got calculators, retirement calculators, Roth conversion, those sort of things that are helpful for some people. And there are disclosures that you can find at the bottom. You can also register online for our upcoming dinner workshop, March 4th in Roseville at Wood Creek Golf Club from 5:30 to 7, or just give us a call at 916-967-3500. And our office manager, Kathy, would love to put you down and RSVP for a seat. Again, capacity is limited, so better to call earlier rather than wait till the last minute. Don't want to have to turn away people, which we have sometimes in the past. So I left off with tax loss harvesting because we are in tax season. And so you are going to be going through all of your tax documents that's going to be flowing in from your, different institutions out there that you have your assets, and specifically your brokerage and taxable investment accounts. And what you're going to be looking at on there is, capital gains, dividend taxes, and interest taxes that you're going to be responsible for. And tax loss harvesting, what we'll do towards the end of the year or, different points of the year. So for example, last year, 2025, we had a very volatile period during April where markets saw a 20% drop. And it was short-lived because then AI euphoria came back. The Fed's, coming in and saying that they're going to cut rates, help to boost and support the market. And so we saw, a nice upswing from there, and market finished out, positive 16, 17%, at least the S&P 500 did. So what we do is take advantage of some of those time periods, either the volatile time periods throughout the year, or if not, look towards the end of the year and say, okay, what are some of the positions within your portfolio that we can capture some of the losses, right? Realized. You have realized and unrealized gains. And so then we want to realize some of the losses to offset any of the gains within your portfolio. So that way, when you get your 1099 the following year and you're doing your taxes, maybe the unrealized gain was, let's say, $50,000, right? I'm not talking about, because sometimes there's a misconception like, wait a minute, you're going to capture some losses. So does that mean that I lost money in my portfolio last year? No, the unrealized is what you're looking at really. And that is, hey, my portfolio, I have $1 million. It went to $1.1 million. So overall, that's a 10% return of what it did, in the last year. But inside of that, we might have captured and realized some of the losses, right? Because maybe you had some buys and sells within the portfolio that captured some gains within there. And so what we're trying to do is just to offset and shrink some of that capital gain. So then when you get your portfolio, or not your portfolio, I'm sorry, your 1099, it'll show, a less, lower capital gain, sometimes even a negative. I've had some clients recently that I've been able, and we've been able to actually capture a loss where they're showing a loss, capital gain loss last year on their portfolio, right, on their taxable investment account, but their portfolio has actually grown in value, right? And so that's a great scenario. That's an ideal scenario. It doesn't always happen that way, but that's an ideal scenario for somebody like, hey, my portfolio value went up, 8 or 10% last year, but then my 1099 shows I actually have a captured capital gain loss. And that's what you can use to either offset previous gains, existing gains. If you don't have any, you can carry forward some of those losses. Again, another conversation that you'd have with your CPA or accountant. But those are some strategies that we look to use to create some efficiency around your portfolio. And it's not just buying, some names, setting and forgetting, and then, that's it. We want to try and be as efficient as possible to get you to where you want to go from point A to point B, to reach your financial goals without having to take any unnecessary risk or pay unnecessary taxes for that matter. The other, dealing with taxes that we've done with clients as well is, people who have concentrated positions. So, we've had clients where, hey, I've had this, thousands of shares of XYZ stock or whatever it is, because they worked for a company for many years or retired from a company and they've acquired a lot of their company stock. And so it's strategizing. Last year we had sold some, diversified into the portfolio, and then tried to offset some of those gains, right? Because you have a low cost basis. I have clients that have HP, Sherwin-Williams, Visa, NVIDIA, what have you. But when it's in a taxable account, that's what matters, because when you sell off a stock that you've had for such a long time, you're going to have a gain in it. So some of the tax loss harvesting and finding some of these, areas where you can capture some losses, it helps to offset some of those gains, and it buffers that blow when it comes tax time that you're filing for, like we are now. And then we look to this year. Now it's a new year. Hey, where does it make sense and how much should we be selling off to then further diversify and take advantage of, maybe hopefully a high point in that company stock that you have. And then the remainder of this year, we'll look for areas to capture some losses to help offset some of those gains. And that's really the strategy around tax loss harvesting, and a couple different methods, right? Just regular portfolio management or maybe concentrated position. But those are areas that John and I look at and pay attention to throughout the year for the clients that it makes sense for us in those specific accounts. In general, overall, what I've touched on is, in this show is just where the stock market is. We're in a little bit more of a volatile period currently. It's mainly from AI skepticism and some earnings concerns, i.e. like Cisco, which dropped like 11 to 12%. But the backdrop of the economy, we're in solid ground. And the January jobs data proved that, because it was way higher than the estimates. And we're still showing economic strength and resilience. So, it's not going to be a smooth road. We are, optimistic about the market. We think there's room for growth, but it's different now. It's not the same as it has been for the past few years, where it was really dominated by the Magnificent Seven and some of these tech names and just focused on AI. And so you have to be more choosy on the sectors, areas, asset classes, or individual stock names that you're picking and putting into your portfolio. And that's where we can come in to help you, hopefully, if we're the right fit, to put those appropriate pieces together that make sense for you, for your specific timeline, for your goals, what's important to you and your family or your financial concerns, along with a financial plan, right? And they're married. The plan is the foundation, and that's the framework of what we work off of. And then the investment assets, morph to align with that plan. And as time changes, or time goes on and things change within your life, we make those necessary adjustments within the financial plan, and then along with necessary adjustments within your investment assets, so they continue to align and create longevity to help get you from point A to point B. And that's really what it's all about. Hopefully this show was helpful and you found some interest. If there are any questions for us, if there's things that have piqued your interest you'd like to talk further about, feel free to give us a call at 916-967-3500. If you are in the area and would love to, come see us live in action, learn more about who we are, how we help our clients, a little bit of insight of the market economy, where it's been, where we think it's going, come join us on March 4th from 5:30 to 7 o'clock in Roseville at the Wood Creek Golf Club. Again, you can reach us 916-967-3500 to get a seat in that seminar, or just to give us a call and schedule a no obligation consultation. It's been great talking with you. Hope you guys have a great weekend, and talk to you next weekend.